Welcome to Acera's new employee slash mid-career seminar. In this seminar, we're assuming that you're either new or you're somewhere in your mid-career, hence the name. So you're not near retirement yet, which is a good thing because it means that you still have plenty of time to plan for your retirement in the future. So in this seminar, what I'm going to tell you is all the things you might want to know about doing that retirement planning. And since you are curious enough about retirement planning to watch this, you probably have some questions. Questions like, what do I need to know about my pension? Or do I need to do anything? And if so, what do I need to do? Well, we're going to answer those questions during the presentation. And we're going to answer them. I've broken down the presentation and organized it into the form of a checklist. So I'm going to help you understand some retirement basics. I'm going to help you understand a little bit about pension math, and it will describe to you how we calculate your retirement, but it will also tell you how you're earning the retirement that you're earning. I'll help you get a pension estimate. I'll help you understand retirement eligibility. That's some point in the future when you become eligible to retire. I will help you understand additional benefits that we offer. And I'll talk about designating your beneficiary or beneficiaries. And then we'll talk about career planning options and making a retirement planning picture. So these are kind of the planning for the future items. We'll talk about starting a 457B account, and that's the point when I will bring in a representative from the county's deferred compensation program to talk about those type of accounts. And we'll also talk briefly about signing up for Acera News. Let's get started. First item on the checklist, understanding retirement basics. Okay, who is Acera? Well, Acera is the Alameda County Employees Retirement Association, in one sense. But beyond this acronym, it's made up of people. So there's about 90 of us that work at Acera, and what we do is we provide retirement, disability, and death benefits to our members. So that's all of you. You are our members, so you're part of Acera as well. And the reason that you're part of Acera is because of the position that you work in and who you work for. So you work for one of these public agencies in Alameda County, and you work, or at some point you worked, in a full-time retirement eligible position. Because you work or worked in that position, that automatically makes you an Acera member. So how does your membership work in Acera? You are, with every paycheck, contributing to Acera's fund. So this is you, and this is you contributing to Acera's fund in your paycheck. And if you look at your pay stub, you will see a line in the before tax deductions column, and that is your contribution to Acera with every paycheck, coming out of your paycheck and going in to Acera's fund, like so. Every time that happens, your employer also makes a contribution to Acera's fund. And so we have this money sitting around. So what do we do with it? We don't just want to let it sit there, so we're going to invest it in various types of investments all over the world with the goal of earning interest. And so your employee contributions, your employer's contributions, and the interest that we earn are the three sources of income to Acera's fund. That's what gives us this big pool of money that we call Acera's fund. So then what do we do with that money that we're collecting and earning? While we are collecting and earning that money, meanwhile, you are working and you are earning credit toward retirement as you work. And then at some point in the future, you are going to retire. And once you retire, you're going to collect a monthly lifetime allowance. It's going to be a retirement allowance you get every month for the rest of your life. You cannot outlive your retirement allowance. It's really a beautiful thing. In fact, it's such a beautiful thing. Pensions are so special that everything that you contribute throughout your entire career, including the interest that we are going to pay on top of your contributions in your contribution account, you're going to get back in that first 3 to 5 retired years. So as soon as you retire, everything that you paid into the system throughout your career, you're going to get it all back within the first 3 to 5 years. And then hopefully you live a long retired life after that, and everything after that is just, it's almost like a bonus for you. But there are some very good reasons and ways that work that allow us to pay you that lifetime retirement allowance. So you can expect your retirement allowance to be there for you when you retire. Just make a quick adjustment here. Okay, let me show you some pension milestones. This is kind of a high-level view of some of the milestones you'll see in your career regarding your ACERA membership. The first milestone on the chart is your date of hire. This is the day that they first told you to show up to work. And that is if you started out in your full-time retirement eligible position. Now, if you started out in some other capacity, like maybe you started out part-time, once you were promoted or you gained that full-time retirement eligible position, this day would be the first day in that position, is what we would consider your date of hire for the purposes of this milestone chart. Okay, then what happens is 2 weeks goes by, and the first day of your second pay period, that is your first day of ACERA membership. And that is the day that you start earning credit toward retirement. Okay, so let's say that you work full-time and you work for 5 years. Once you have 5 full-time years of service credit, you're considered vested in the retirement system. And vesting, that word just means guaranteed. So once you are vested in the retirement system, you're guaranteed the vested benefits. You're basically guaranteed the guaranteed benefits. Okay, then some other period of time goes by. It's going to be different for everyone, because you're going to achieve retirement eligibility at some point in the future after you're vested based on your years of service credit and how old you are. So there's different combinations of years of service credit and age that can get you to retirement eligibility, and I'll show the details of that to you during the presentation. But after that day, that's the first day that you're eligible to retire and you can retire. But you don't have to retire yet. You can keep working and earning retirement, and most people do. Okay, so then some point in the future after that is going to be your retirement date. After you have earned enough retirement or you're just ready to get the heck out of here, there's going to be a day that you choose that is your first day of retirement. And this is the day that you start collecting that retirement allowance that you've earned throughout your career. Okay, but it doesn't stop there. Your death is a milestone on the pension milestone chart. Sorry about that. It is inevitable, but the reason it's here is because it's in between these two dates that you are earning your retirement allowance. So you're going to earn your retirement allowance all the way up until you die. And then there's an additional milestone on here because there are some death benefits available to your beneficiaries. And if you choose certain options at the time of retirement, those can leave a continuing payment to a beneficiary, one or more beneficiaries, for the rest of their life. And that can continue until their death. So that's why that is a milestone on here as well. Okay, so let me check the questions here. Okay, I'm going to save the second question for later. The first question is, are you vested by how long you've had money in ACERA or how long you've contributed? You're vested by how much service credit you've earned. Okay, so once you earn 5 years of service credit, and that includes reciprocity, which we'll talk about later, but reciprocity is basically the linking of retirement systems together. So if you used to work for a different public agency and you've linked the systems together, the 5 years combined, 5 full-time years combined, would get you over that 5-year service credit mark in order to be considered vested in the system. And vesting is guaranteed. The guarantee of the vesting is guaranteed by state law. Okay, and here are the vested benefits. So here's the lifetime monthly retirement allowance, and here's a cost of living increase that happens annually to that retirement allowance. Plus there's a $1,000 lump sum death benefit that's considered vested. Now there are other death benefits, like I was mentioning earlier, that are also part of the vested benefits. But this is just kind of like an extra burial benefit. Okay, so I think, and also to continue answering that question about when you become vested, I think it'll be a little more clear once we get to the the topic of earning service credit. Okay, let's see. So questions. After your death, your beneficiary is eligible to receive retirement payments until their death. Often, depending on which retirement option you select and whether it has a continuing lifetime benefit associated with it. If you want more information about that, you can check out our death benefits page at acera.org/death. Okay, regarding what happens if you vest after 5 years and leave, what happens to the money, we will answer that question during the presentation. Does buying back years count as vested years? Sometimes, and we will answer that. What happens if you leave before the vesting period? We will answer that. Let's see. Okay, regarding the contributions, you are contributing to the system, and so there's a question about how much the employer contributes. The kind of standard is that they contribute the same amount as you, but they're also making catch-up payments because we're not 100% funded. So they're actually contributing at a much higher rate currently until they make those catch-up payments, and then we will be considered 100% funded, and then it'll be kind of roughly even. Regarding what we invest in a very diverse array of investments, including stocks, bonds, private equity, and various other things. And if you want more information about that, I suggest checking out our investment page under the About Acera heading on our website. Okay, what's the earliest age you can retire? We'll answer that later. So I'm just going to go ahead and dive into more of the presentation because I think a lot of these questions will get answered throughout the presentation. Okay, so and maybe if you have a question, maybe limit it to the topic that we're talking about, and we'll just kind of see how that goes. Okay, so let me tell you about your tier. Your tier is based on your date of entry into Acera. So if you remember from the pension timeline, that is the first day of your second full-time pay period. You can verify what your date of entry is in your online account at Acera. The way that you, I can show you what your tier is on this chart if you happen to know what your date of entry is roughly. So what you do is you first determine which timeline you're following here. Safety members are sheriff's deputies and probation officers and perhaps other sworn officers. So you would look at this timeline. Everyone else is a general member. And general members who work for the Housing Authority or Livermore Area Recreation and Parks District would look at these two timelines. All the other general members, you look at this timeline. Now the way the timeline works is there's a cutoff date for each tier. So for tier 1, if you entered Acera on or before July 1st, if you entered Acera before July 1st, 1983, you would be in tier 1. So on or before June 30th, 1983. That puts you in tier 1. If you entered Acera July 1st, 1983, all the way up to December 31st, 2012, that puts you in tier 2. Now, if you entered Acera January 1st, 2013 and beyond, that puts you in tier 4 for all of the tiers, for all of the different timelines. For the Housing Authority and for LARPD, there is a couple of different kind of time marcations here. And for safety members, there are some different marks here that put you in different tiers. Especially this one I want to point out, Tier 2C and Tier 2D. If you entered Acera October 17, 2010, all the way up to December 31st, 2012, you either went into Tier 2C or Tier 2D, and you made that selection within 45 days of achieving your safety membership. So if you don't remember what you selected, you can log into your account and see which tier you're in. Okay, so but this kind of basically for the purposes of being in the presentation right now kind of points you to what tier you're in. Okay, next item of pension basics. What retirement planners and financial planners will tell you is that in the future, when you go to retire, you will need 70 to 80% of whatever you were making before retirement. You will need 70 to 80% of that income in retirement in order to maintain your standard of living. And that's going to come through a few different sources. It can come through a few different sources. One of those is the Acera monthly pension. Another is Social Security, and everything else is savings and investments. Okay, so I just want to introduce this idea right now. We will return to this slide at the end of the presentation, because the order that we're going to do this in is I'll talk about how the Acera monthly pension works and is calculated first, and then we'll go into a little bit about Social Security and a little bit about savings and investments at the end of the presentation. Okay, let's dive into understanding pension math. Let me check the questions here real fast. Okay, one question is, how do we contribute more money? You cannot contribute more money to Acera. If you have extra money to contribute, you can use that to put into your 457B account or other investments, and we'll talk about that during the presentation. Okay, and regarding the one about making a service credit purchase, we will answer that in just a few minutes. Okay, let me save that one. How does Acera find somebody to start paying them when they retire? Well, we have your information in our database. Your employer transmits your address and phone number and email. But beyond that, if you want to start getting paid, then you should make sure that that information is correct in our database. Otherwise, there's a whole process that we lead you up to retirement. There's a counseling session and other things. So don't worry, you'll get paid. Okay, regarding benefits paid to beneficiaries, let me save that for later. Let me save the reciprocity question for later. Yes, I'll address purchasing and temporary assignment pool time. After retirement, pension payments are not really reduced by the amount of Social Security. They're not reduced by the amount of Social Security you draw. There is, if you are a general member, there is a slight Social Security reduction based on the fact that you are going to receive Social Security, but it's like a few dollars. But it doesn't matter how much Social Security you're going to draw. There's not going to be a reduction, so you're going to get Social Security and your pension. Why and how do the tiers change? They change because of state law sometimes, and they change because the county decides to adopt a new tier. That's what happened in the past. So tier 1 was what they started out with. Tier 2 is something that was adopted by the county and the other employers at some time in the past because they felt like they needed to adjust the level of benefits. And then in 2013, the state created tier 4, and basically everything is tier 4 from here on out. So once you're in that tier, though, you're in that tier, and that doesn't change. So your personal tier never changes. Yes, we're about to cover what percentage each tier receives. Okay, understanding pension math. In retirement, you are going to get a percentage of your highest salary for each year of service. And that is reflected in this multiplication. This is our pension formula that we are going to calculate at the time of your retirement. And the percentage that you're going to get is this factor right here, the age factor percentage. The years of service is here and your salary is here. So let's do an example. Let's say that the percentage of your highest salary that you're going to get for each year of service is 2%. And let's also say that you earn throughout your career 20 years of service credit and then you retire. So basically you work full-time for 20 years and you retire. You are going to get 2% of your highest salary for each one of those 20 years that you work. That means that you're going to get 40% of your highest salary in retirement, because when we multiply 2% times 20 years, we get 40%. Now let's say your salary at retirement, your highest average monthly salary is $5,000. That's what you were making before retirement. Since you're going to get 40% of that in retirement, in this example, you would get $2,000 per month, every month for the rest of your life. Now there would be cost of living increases to that as well. So that is how the formula works. The basic idea is that the higher, because this is a multiplication, the higher any of these numbers are, the higher the age factor percentage, the higher the years of service credit, so the longer you work, and the higher the salary you make is going to equal a higher retirement allowance for life. So when I say you're earning credit toward retirement, you're earning it in these three categories. You're earning higher credit by getting older, by working more, and by earning higher and higher salaries as you go through your career. So what percent of your highest salary will you get for each year of service? Well, it's going to depend on what age you are at retirement. So here's a sample age factor percentage chart. And the first thing that you're going to want to do is find your tier. So you just look at that one column and you forget all the other columns. So for example, if you're a general tier 2 member, you just look here. A general tier 4 member, you look here. And the various safety tiers, you would just look at your one column. Okay, now the way this works is when you go to retire, let's say that you are a tier 4 member who's going to retire at age 62, we're going to need to do that calculation for you. So we're going to come over to the age factor percentage chart. We're going to go tier 4. You're in tier 4. We're going to come down to age 62, find where those intersect, 2%. That's what you would get in the formula for you. Now, if instead you decided to work a few more years, maybe 3 more years, and you're a little bit older when you retire, then you would get a higher percentage in the formula, 2.3% of your highest salary for each year of service. And all the tiers have a maximum percentage that you can get. So if you retire older than the maximum percentage, you just get the maximum percentage. So for example, if you're a tier 2 member and you retire at age 65, you get 2.43%. If you retire at age 66 or 67 or 77, it's still going to be 2.43%. So at a certain point, certain age, you reach the maximum percentage for your tier, and that is highlighted in each one of the blue boxes for each one of the tiers. One thing that you may notice about the chart is that I skipped a bunch of the ages, and that's because there's way too many incremental increases to fit on the slide. And in fact, the incremental increases happen with every quarter year you wait to retire. So you can, if you like math and you want to see what all those quarter increments are, you can go to acera.org/age, or you can just search for age factor percentages on our website, and the full chart will be there in a PDF. Regarding the question, can you retire beyond 67? And because you're asking that, I'm guessing that you're in tier 4, absolutely. You can keep working 68, 69, 79, 89. You can keep working. There may be, now that I said that, somebody mentioned something about a required minimum distribution for the pension plan, which we're researching, and that could happen at age 70. So if you have more questions about that, that might be a good thing to call into our call center with, or you can write to us at info@acera.org. Okay. Why is the percent on tier 4 members so low in comparison to the other tiers? That is because the state of California back in 2012 decided to make a slightly lower tier in order to basically placate the public who thought that the pensions were too rich. So they created this tier 4. It has as you go along for each age, it does have a lower age factor percentage than tier 2, but it does max out higher, 2.5% for 2.43%. So it's a slight consolation, but that is why. The monthly salary is going to be gross, to answer your question. It's going to be gross salary, and we will answer that question later. Okay, so that's how the age factor percentages work. Since retirement is so far away for you, because you are either a new employer or you're in your mid-career, you might not need to like hone in on a specific age factor percentage at this point, but just kind of the bottom line is that the older the retirement age you are, the higher the age factor percentage up to the max for your tier. So if you don't remember anything else, that would be the thing to remember about the age factor percentages. Okay, let's move on to talking about earning service credit. So we talked about the age factor percentage, now we'll talk about service credit. You start earning service credit on this day, your date of entry. You will finish earning service credit, you stop earning service credit when you leave your job. If you go straight into retirement, you'll stop earning service credit the day before you retire. If you stop working before that and retire later, then it would be, you would stop earning service credit when you stop working. And so there would be an additional milestone here for you whenever you terminate your employment. You earn service credit during your regular work hours. You also earn service credit during your earned leave time. So vacation leave, sick leave, management leave, comp time, holidays, floating holidays. Those do not count against you in regard to earning service credit. You are already earning service credit while you're out on those leaves. Now, you're not earning service credit during these times. If you ever go on leave without pay, you're not earning service credit during that time. If you purchase additional vacation on top of your earned vacation, while you're out on the purchased vacation, you're not earning service credit during that time. So if you mark purchased vacation on your timesheet, while you are using up that purchased vacation, you're not earning service credit, and you can't buy that back. Also, if you sell vacation back to your employer, you're not going to receive service credit for it, but you're going to get cash. So cash is nice. And then you also do not earn service credit during overtime, on-call time, or standby time. So let's talk about purchasing service credit. This is a really good topic to know as a new employee or if you're in your mid-career, this concept of purchasing service credit. There are some types of time that are eligible for you to purchase. And the way to think about it is mostly that it's sort of a type of time that if the circumstances were slightly different, you probably could have earned service credit for that, but you were unable to because of the circumstances. And so you can come back later and buy that time. And so these are the types of time you can purchase. This category is kind of called ineligible non-covered service purchase. This is kind of what I'm talking about, that you didn't earn service credit for it, but then they consider it purchasable time later once you achieve your ACERA membership. So if you started out part-time, and we're not talking about being under contract or working as a temp for temporary agency, employment agency, that's not what we're talking about. This is just plain old part-time. You are working for your employer. That is purchasable once you become an ACERA member. Now, the one temporary type of time that people call temps, temporary workers, is the county's temporary assignment pool, which is what TAP stands for. So all of your TAP time is purchasable, okay? And then seasonal work, intermittent work, service as needed, project and per diem work, these aren't common times, but you might have done some work for your employer in that capacity, and those are purchasable as well. Okay, so then there's the days between your hire date and your entry date. That would be the 2 weeks between your first day of work and your entry date into Acera the first day of your second full-time pay period. That 2 weeks is purchasable. Next category is unpaid medical leave. Should you go out on unpaid medical leave during your employment, once you return from that leave, you can purchase that time up to a year per instance. So if you are out on a year of unpaid medical leave, you return and work a little bit, you go out on unpaid medical leave again for a year, you return and work, both of those periods are purchasable. If you're on unpaid medical leave for a year and a half, only a year's worth of that would be purchasable. Okay, the state disability insurance leave, same thing. Military leave, same thing, purchasable upon your return. I don't know if there's a year limit to the military leave. There might not be a limit for that. If you have questions about that, you should call our call center or write to us at info@acera.org. Redeposits of prior membership. This is where you used to be an Acera member in the past. You stopped working for whatever reason, so you were no longer working your job, and whenever you left, you took a refund of your contributions and interest. But now you're back. You're an Acera member again. And if you want to redeposit that money that you took a refund of, you can put that money back, and you will get all of your service credit back from your prior membership. A similar type of purchase, which is called a redeposit of community property. This is where you were earning your Acera service credit, and then you got divorced or you dissolved your domestic partnership, and part of your service credit was divided out as community property in the settlement to go to your ex-spouse or ex-partner. If that person, they would get like their separate account. If they take a refund, then at that point, we will notify you and you can redeposit that money. You're basically making a purchase of that and to get that time back. Okay, now the last category is other prior public service. If you used to work for a different public agency in California, some examples are CalPERS or other counties or the state or East Bay MUD, Port of Oakland, and you're not eligible to collect a pension under whatever retirement system they use, usually because you didn't work there for long enough to be vested in their system, or you took a refund of your contributions when you left there, you can buy that time as Acera public service. As long as you go ahead, if you haven't taken the refund yet, you go ahead and take the refund from their system. And so that is a purchase that you can make as well. Let me see if there's questions here. Okay. Okay, let me take some of these questions in just a minute when I get to the end of the service credit discussion. So the times that are not eligible for you to purchase. Vacation purchase time, that is not purchasable. So if you purchase additional vacation on top of your earned vacation, that's nice. You can take the extra vacation time, but you don't earn service credit for it and you can't purchase it back. If you go on leave without pay that's not medically related, then that's not purchasable. Also, the medical leave without pay, this is for your medical conditions only, not for like a partner's or parent's medical conditions. Contract or temp agency time is not purchasable. And if you still have contributions on deposit with a different public agency you're trying to buy that time, you can't make that purchase until you take a refund from their system. Now, how much is it going to cost for you to make the service credit purchase? Should you already have that time, or sometime in the future you have one of these types of time? What it's going to cost is whatever your employee contributions would have been had you worked the time. So for example, if you're trying to buy 3 months of unpaid medical leave that happened 5 years ago, then had you been working for that 3 months, you would have been contributing to the retirement system at a certain rate based on your own situation, and whatever that money would have been, that's what you pay. That's going to be what you pay to make the purchase. Plus, you're going to have to pay the interest that money would have earned in a Sarah's fund between then and now. So if that was 5 years ago, to stick with that example, we post interest twice a year, and so that's 10 individual 6-month interest periods that we were earning interest, that money would have earned interest. So you have to also pay the interest that money would have earned had that been with the system for us to invest. The way that you make a service credit purchase, or even just find out what it's going to cost, is by making a purchase redeposit request to Acera. And so the best way to do that is to log into your account at acera.org, and there's a web form in there called Purchase Redeposit Request. So you can go to our website, click the account login button, or this URL will take you straight there. There is a paper form on our forms. It's a PDF form on our forms page as well, out on our public website. And once you submit the request, we'll do some calculations, and then we'll send you a letter in the mail with how much it's going to cost. And at that point, you decide if you want to make the purchase or how much of that purchase you want to make. So to go back to the list, for all of these types of time, actually all of these types of time except for the redeposits, so this one and all of these ones, you could purchase just a portion of it if you so choose, but the redeposit is all or nothing. And then I had the question earlier, do purchases count toward vesting? All of these ones do, but this one does not. Also, just to let you know about the costs, these ones are going to cost a lot less than this one, the other prior public service, because with all the other ones, you're paying the employee contribution, but with the other prior public service, since the employer was somebody else, you're going to have to pay the employee and the employer contribution, and it's probably going to cost about triple what the other ones cost. So that other prior public service ones can be costly. You are welcome. Okay, so I have a question. Took 2 months of FMLA, wondering if you need to purchase the service or it's considered the same as sick time. So this is a good question to answer right now, because if you are out on sick leave, you already earned service credit for that time, so you can't purchase it because you already earned service credit. Or if you were kind of out on sick leave, you ran out of sick leave and then you started using other leave balances, as long as you're using leave balances, you're already earning service credit and it's not purchasable. Then if you run out of those leave balances and you're still out on family medical leave, as long as it is unpaid medical leave for your medical condition, then that's purchasable and you can purchase it upon returning from that leave. Are the Acera contributions tax deductible? Yes. You make your contributions on a pre-tax basis, and so that reduces your tax liability while you are contributing to Acera. How do you find out if you have available service credit to purchase? One way is just to think back, do I have any of these types of time? If you're uncertain, you can't remember, the best way to do it is just to go ahead and submit that purchase request form and kind of describe the type of time that you're thinking, you're wondering whether it's purchasable or not, and then we will do some research in your payroll records and we will find out for you whether that's purchasable and let you know. And when you purchase the service credit, is it tax-free? So that leads me to my next slide, which is the different payment options that you have if you're going to make a service credit purchase. So once you decide to make the purchase, you have these payment options. You can roll over pre-tax funds from a different retirement account if you have one, so that's the only pre-tax method. Beyond that, if you don't have enough money to roll over or you don't want to use it, you can write us a lump sum check, or you can make payroll deductions, but those are going to be on a post-tax basis. Or you can do any combination of these things. Okay. And then regarding what the cost is, the cost is going to be individual to you, and so you're going to need to submit the purchase request in order to know what the cost is, because we'll do that calculation for you. Regarding METOP, I don't know what METOP is, so maybe you could write in what that is. Okay, so I have a few questions about TAP here. So let me get to that, and then I'll talk a little bit more about purchasing service credit. So you were a TAP employee for 6 years, and then you became a permanent employee 1 year ago, and you want to know whether you would also get the vacation leave that you didn't earn while you were on TAP. I don't think so. I think TAP employees, if you don't earn vacation leave, you don't earn vacation leave, and so you're not gonna get that in the future. But all of that 6 years of TAP work would become purchasable, and that would increase your service credit by 6 years if you do purchase that. So that's a lot of service credit to have included in your retirement calculation. Okay, you were TAP for 3 months. The county hired you again, and you're currently on TAP for 8 months. So if you leave TAP and work somewhere else, and then return as a permanent full-time county employee, can you still purchase those 11 months? Yes. So it sounds like you're not an ACERA member yet. Because if you were an ACERA member, I don't know why you would go back into TAP. I haven't heard of that, but maybe that's something that they do. But if you're not currently an ACERA member, you can't make the purchase yet until you achieve that full-time retirement eligible position, and then all that 11 months would be purchasable. If you resign from the county before getting vested and return as TAP, can that count toward getting vested? If they'll let you return as TAP, yeah, I think you would, like if you're, this is kind of similar to the previous question. I think if they let you return as TAP, then that means you're kind of not an active member, you're a deferred member, which is kind of a member who's on hold and not currently earning service credit. And so I think what would happen is you would be earning that temporary assignment pool time would be building up, but you would have to achieve another full-time retirement eligible position in order to buy it. I think that's probably how it works, but that is, I think you would want to go ahead and call our call center and ask that question, because I'm not sure I'm giving you the right information. So if you worked as TAP for more than a year, you start purchasing time. How do you start purchasing the time? So if you are already an ACERA member, then this is the way you do fill out that purchase request form, and that's how you begin that process of purchasing the service credit. Okay. Yeah, and there's another question about being TAP, then going to full-time, then becoming TAP again. I think in those scenarios, you all should go ahead and call our call center and ask how service credit is tabulated in those examples, because I don't know for sure and I don't want to tell you the wrong thing. Okay, the METOP is a mandatory time off without pay, and that was 1 day off per pay period in the early 2000s when the county was hurting. My guess is that you probably already got service credit for it, but that would be something to call into our call center to verify. Typically with those types of time, you don't get dinged in terms of service credit, but yeah, you should verify that with our call center. Okay, what's the deadline for purchasing service credit? The deadline is you have to purchase it by the time you retire. You have to finish purchasing it by the time you retire, and that's the only deadline. One more thing I'll say about making that purchase is because this interest is building up, the sooner you purchase service credit, the cheaper it is. Another way to say that is the longer you wait to purchase service credit, the more expensive it gets. So the time to purchase service credit is as soon as you can. And you can always do the payroll deductions if you don't have money sitting around to just make a service credit purchase. You can do it through payroll deductions. And the limitation on payroll deductions is that we will spread it out over the same amount of time you're trying to buy. So if you're trying to buy a year's worth of time, we can split the cost of it over a year's worth of your paychecks. There's a question, is there a maximum amount of service credit that we will put in the calculation for you? No, there's not. Sort of. You're just going to keep earning service credit until you stop working. But there is a limitation that you can't earn more in retirement than 100% of whatever your highest average salary is calculated to be. So that's kind of trying to prevent you from earning more in retirement than you were making as a working employee. And as a tier 2 member, you have to work at least like 45 years to get close to that. For tier 4, I'm not sure what it is, and be pretty old. So you pretty much most people don't hit that limit. So you really don't have to worry about that. You're just going to keep earning service credit the longer you work. The call center's phone number to answer that question is 510-628-3000. Okay, so moving on. This kind of answers this question: who would benefit the most from purchasing service credit? Is purchasing service credit worth it? I can't tell you for you whether it's going to be worth it, but you can figure it out for yourself. And here's how you do it. You log into your Sarah account. So you go to our website, click the account login button, or go to this URL. There's a benefit estimator in there. You run one estimate based on the retirement scenario that you are considering. So just get kind of close to what you're thinking. I'm going to retire in 20 years or 10 years or whatever it is. And so you run that scenario based on a certain retirement date. There is a service credit override field because they're in the benefit estimator. So in this scenario, it's going to make a projection on how much service credit you will have earned in this scenario. For the estimate number 1, you do not override that projection. You leave that blank. Then you run the estimate. It's going to give you an estimate of your lifetime monthly pension. Then you do a second estimate. You use the same retirement date, but then you override that projection in the service credit override field. So if in this estimate it was projecting you were going to have 20 years of service credit in this scenario, and you are considering whether to buy 6 months of service credit that is eligible for you to purchase, in the service credit override field, you would put 20.5. So you would increase that number by the amount that you are considering purchasing. And then you run the second estimate. Your pension that it's going to estimate is going to be higher because there's going to be more service credit in the calculation in estimate number 2. Then what you do is you just look at the difference between the 2 estimates that you did. So you just subtract the pension estimate number 1 from number 2. So it's estimate 2 minus estimate 1. And this tells you what the difference is. This is the increase to your monthly allowance that it's estimating you're going to get based on making that service credit purchase. Then what you do is you take the purchase costs that we sent you in the letter. So once you filled out the service credit purchase request, we did our calculations and we sent you a letter in the mail saying this service credit purchase is going to cost you $3,000 or whatever it is. So you take that $3,000 and you divide it by the difference in your monthly allowance between the 2 estimates, because this is the amount more that the purchasing the service credit is going to get. And so what you're doing is you're figuring out how long it's going to take you to get that money back if you make the service credit purchase, because you are going to have a higher retirement allowance if you do make the service credit purchase. It's just depending on how much higher it is and depending on how much the cost is, that's how you decide whether it's worth it for you. So if you do this calculation and it tells you in retirement, based on having a higher retirement allowance, it's going to take me 3 years to get this purchase money back that I paid in to make the purchase. And then after that, for the rest of my life, I'm going to have a higher retirement allowance. That sounds pretty worth it. Now, if you do the calculation and it's going to take you like 20 years to get the money back that it cost you to make the service credit purchase, maybe that's not so worth it. So that's how you decide whether it's worth it for you. Okay, and regarding, so there is a question about how long it takes us to calculate those service credit purchases. I don't know what the current estimate is. Maybe you could say how long ago you did that service credit purchase, because we have refined that process so that the wait time is shorter, and it sounds like it took you 10 months. So I'm wondering if that was a while ago. It might be quicker than that now, but it does take some time because we have a lot of these requests, and it does take a lot of work to make these calculations. Okay, and somebody's saying it took you 4 months. That's probably what what it could take around now. And that was 2019. So that was about the time that we were refining that process. So it's probably quicker now. It's probably more like what the other person is commenting, 4 months. Okay, regarding if you're only a TAP employee, you don't qualify as an ACERA member yet until you get the full-time retirement eligible position. But you may stick around because you can see like kind of what the power of the benefits are once you get that full-time retirement eligible position. Okay, so the question is on the slide where I was telling you how much the service credit purchase is going to cost. This employee contributions, that's your contribution only. That is not including the employer contribution for all of the types of service credit purchases, all of these ones. This is employee contribution only. Now, if you're purchasing other prior public service, you're going to pay the employee portion and the employer portion. That's why I was saying it's going to cost like triple. Yes, you still earn service credit after 30 years of service. You keep earning service credit as you work. So yeah, when purchasing the California other prior public service, you do have to pay the employee and the employer contribution. Okay, so you were out on workers' comp leave, it sounds like maybe for a couple of years or maybe a couple of times. And while you were off, did you contribute to your ACERA account? Probably not. I mean, if you were still using your leave balances, well, until you ran out of them, you were. But once you went on workers' comp leave, sometimes also known as state disability insurance leave, you were not, if you weren't receiving your paycheck from your employer, you were not earning service credit and you were not making contributions. And so then that time, if it's unpaid medical leave time or state disability insurance leave time, is purchasable. And if you worked for a subcontractor of Alameda County, that's usually not purchasable, but that would be something to verify by calling into our call center at 510-628-3000. And yes, we're going to hang around after the webinar to answer any other questions that are remaining. Okay, moving on. So we talked about the age factor percentage. We talked about the years of service credit. Let's talk about the salary component of the formula. When you go to retire, we are going to need to calculate your highest average monthly salary in order to calculate this retirement formula for you. If you're in Tier 1 or Tier 3, and since this is a new employee or mid-career seminar, there's probably not a lot of Tier 1 or Tier 3 people in here. Tier 3 is just for Livermore Area Recreation and Parks District, and Tier 1 are people who entered ACERA quite a while ago. But if you are in one of those tiers, what we are going to do is look at your highest consecutive 26 biweekly or 12 monthly pay periods. If you're in Tiers 2 and 4, we're going to look at your highest consecutive 78 biweekly or 36 monthly pay periods, depending on whether you're paid biweekly or monthly. So essentially, for tiers 1 and 3, we're going to look at your highest year of pay throughout your career. And for tiers 2 and 4, we're going to look at your highest 3 years of consecutive pay throughout your career. And then, since our goal for the calculation when you go to retire is to determine your highest average monthly salary during your career during this time that we call your final compensation period, we're simply going to take the total amount of money you made during that time and divide it by the months in that time period. And in the case of tiers 2 and 4, 36 months, and that gives us your average salary over that highest 3 years of pay. Now, this is 3 years of full-time pay, or the equivalent of 3 years of full-time pay. Let's say that you worked half-time for the last 6 years of your career and you were making your highest rate of pay in your career. We would smash those 6 years of half-time together to get the equivalent of 3 full-time years. So working part-time or working less than full-time while you're making your highest rate of pay in your career doesn't affect you in terms of us calculating your highest salary. Now, you would be earning service credit at a slower rate, so it would affect the service credit component of the formula. And so the types of pay that we're going to be looking at are your base pay, and then there are some other types of pay codes that will be considered as pensionable, and they will go into this calculation, but there are like 1,000 different types of pay codes. So if you have other types of pay codes, you can research those on our website and determine whether those will be in or out of this equation. And then if you're in tiers 1 or 2, vacation sales and vacation cash out up to a limit during that that you are paid during that final compensation period can go into your highest average monthly salary. And if you want more information about that, I take a deep dive into that topic in our pre-retirement seminar. And so you should check that out on our website. There are a number of recordings of that. For tier 4 members only, there's this additional rule where your highest average salary is capped. So there is a cap on how much of your salary per year that can be considered toward making this highest average monthly salary calculation. The cap goes up periodically every year, and it's based on the Social Security wage index limit. So you can always check our website to see what the current limit is. For 2021, it's 128,000 and change for general and 153,000 and change for safety members. And the way it works is if you do have a high salary like that, once you earn more than that in a particular year, then anything above that you make, we stop taking retirement contributions out in those paychecks. So you're not going to get in the calculation the benefit of having the salary above this in the calculation, but you're also not going to make contributions on that amount. And so that's going to give you more money to save in your other investments. Okay, we will go into a lot of these questions in a bit. If you're not vested, can you pull money out when you resign? Yes, and we'll talk about that toward the end of the presentation. Okay, so here is the whole thing put together. In this example, there's a tier 4 member who retires at age 65 after earning 25 years of service credit. So their age factor percentage is going to be based on the chart I showed you, and it's going to be based on retiring at the age of 65. They would get 2.3% of their high salary for each year of service. In this case, they worked for 25 years. So they earned 25 years of service, and their highest salary was $6,000. And so we multiply those 3 things together, and that tells us what their retirement allowance is going to be. In this case, If we multiply these two factors together, they're getting 2.3% of their highest salary for each of those 25 years of service. And that means they're getting 57.5% salary replacement. So that is terminology of retirement planning. And remember earlier in the presentation, we talked about the goal of having 70 to 80% salary replacement. So they are achieving 57% salary replacement just through the pension alone, and that's pretty good because they're going to be able to add the Social Security and other savings to that, which we'll talk about later. Okay, let's talk about getting a pension estimate. I had a question earlier about this chart and how this differs from the tier chart that I showed you. Okay, so I'm going to show you two ways to get a pension estimate. The first way is a really quick ballpark way to get a salary replacement estimate. And you go out to this chart. So you go to acera.org/planning. Let me switch my share and I'll just go out to our website. Let's see, I think it's this one. And here is our homepage. And you are just going to go under members and go to planning your future retirement income. Or you can type in acera.org/planning. If you scroll down here, the first section is getting a retirement estimate, and it takes you through these various options. And the first one is using this income replacement chart. And so the charts are here under the buttons. I'll just go ahead and click on tier 4 and show you the chart. What we've done, the reason that this differs from the age factor percentages is because we've already done the multiplication for you. We've already multiplied the age factor percentage times the years of service credit to populate this table. So to use this chart, you think about what your retirement scenario is. Let's say I'm going to retire at age 60 after 30 years of service. So I worked for 30 years, come over to age 60, and I'm going to achieve 54% salary replacement in retirement. That's how that works. And there is a chart for each one of our tiers. Let me show you the second method. The second method is a more precise method. You go to our website, you click on the login button. Once you get into your account, you will see, and if you haven't made an account yet, you can just go ahead and make one. Your data is already there in our database waiting there for you once you make your account. Once you get in here, you see your account summary screen, and this has a lot of the pension data that we have in our database for you. It has your tier, your employer, your current status, whether you're actively working or you're deferred, whether you have reciprocity or not, your entry date, how much service credit you've earned, how many employee contributions you've made, so on and so forth. You're going to come over here and click Estimate a Benefit. This is the benefit estimator tool that I was telling you about earlier. You are going to do a retirement scenario. In this scenario, you think into the future. I'm going to retire in 10 years, or 5 years, or 15 years, whatever it is. And you can just kind of pick a date that aligns, a set of dates that align with the scenario. If you think you're going to go straight into retirement, you would want to pick 2 consecutive days. Your separation date is your last day of work, and then the next day is your projected retirement date, which is your first day of retirement. But if you don't know what you're going to do, you can still do that, keep it simple. If you happen to know that you're going to stop working in the future and then wait to retire, you can do that scenario as well. Your separation date would be a ways before your projected retirement date. So in your scenario that you're doing, you put in your dates and you hit calculate. And I'm just going to zoom in here so you can see it better. You hit calculate, and this is where it's projecting the amount of service credit you will have earned in this scenario. It's also giving you a salary projection for this scenario. And the salary projection doesn't project any salary increases for the future. So that is why we give you 2 fields here where you can override your service credit if you so choose, or you can override your salary if you so choose. So if you're going to retire in 10 years and you want to see what maybe inflationary increases to your salary will do for your retirement allowance calculation, you can do that here just by increasing your salary. You should leave this blank, and then you can put in beneficiary information in here if you want, and then you hit get estimate, and this is what you end up with. This is a PDF. This has demographic information up here and it's a lot of the information it's using to calculate the estimate. If I zoom in here, what you're going to look at is this box here. Because you are a new employee or you're in your mid-career, and you don't know probably which one of these options you're going to select because it's going to be based on your life situation at the time of retirement, you can just forget about the options. They all pay less than this one, the unmodified option. This pays the most. So this is your highest retirement allowance estimate. So you can just look at that box. And this is your precision retirement allowance estimate for this scenario. And that's how that works. So the projected retirement date, to answer your question, this is your first day of retirement. So if you happen to know, let's say that you 10 years from now, you're gonna retire about 10 years from now. Okay, so it's February of 2021 right now, and so you just pick a date in February of 2031, and you could put that in as your retirement date. And if you happen to know you're going to go straight into retirement, then your separation date, you just pick the day before. Because projecting that far out, I say it's a precision estimate, but it's a rough scenario. How many vacation days can you sell? That is limited by your employer, and so you should ask your payroll clerk what the limitation is on selling vacation. If you sell vacation, does that income count toward your highest salary calculation for retirement purposes? If you have sold vacation already and you're doing a scenario, let's say you're probably in tier 2, or if you're in tier 2, let's say that you're in tier 2 and you have sold vacation, and you're doing a scenario where you're going to retire in the next 3 years, and when you go here, this date range that it's using to do the salary projection, you have sold vacation in that time, then yes. Otherwise, it won't. So for almost everyone who's watching this, it won't. Because if you've sold vacation and you're going to do a scenario like 10 years from now, it's going to basically give you a projection for a time period of a 3-year time period 10 years from now. And so it's not going to include this vacation that you sold in this salary. So basically, the bottom line is if you sold vacation and you're going to retire more than 3 years from now, you don't have to worry about that. And there's a question, is vacation or sick leave included when you leave? It can, and I delve into that topic in our pre-retirement seminar. So that would be a good thing to explore in that pre-retirement seminar. You leave hours of cash vacation blank because this is only for tier 2 people, first of all, and since you're new employees and you're in your you're in your mid-career, it's best to just get a nice conservative estimate where you're not including the effect of vacation on your salary calculation, because you don't know what's going to happen. You don't know if you're going to do that. So you just leave that blank. If you want more information about how vacation affects your salary calculation, there's a post on our website. I think it's titled exactly that, how vacation affects your salary calculation, and you can dig deeper on that in there. Okay, I haven't covered what happens if you leave before you're vested yet, but we will dig deep into that. And the rest of the questions we will get to. Next topic, understanding your retirement eligibility. So we moved up to the next milestone on the pension milestone chart. We talked about vesting. Now we're talking about when you actually become eligible to retire. It's based on a set of criteria. I'll show you the slide for tiers 1, 2, and 3 first, and then I'll show you the tier 4 slide in just a minute. So for tiers 1, 2, and 3, if you meet one of these scenarios, then you are eligible to retire. So your first option for becoming eligible to retire is that you're over age 50 and you have at least 5 years of service credit and you have at least 10 years of membership. So at least 10 years has passed since your date of entry into ACERA. Now you can probably think about that as if you're going to go straight from active work into retirement, then really you would be working for 10 years and be over age 50, and then you can retire. But if you work for more than 5 years and you do leave, you can, as soon and you become what we call a deferred member, which is you stop working and you defer your retirement to a later date, then you can retire later once you achieve that 10 years of membership. So that's option 1. Option 2, if you're a safety member and you have at least 20 years of service credit, or if you're a general member and you have at least 30 years of service credit, you can retire at any age, even if it's younger than age 50. Option 3, if you're age 70, you can retire with any amount of service credit, even if it's less than the 5 years you would need to retire under option 1. So those are your 3 options for tiers 1, 2, and 3. For tier 4, option 1 is that you are a general member and you're at least age 52, or you're a safety member and you're at least age 50 and you have at least 5 years of service credit, and then you can retire. Now your retirement amount is going to be based on that 5 years, so it's going to be a lot less than if you had earned a lot more service credit, but you can still retire and draw that lifetime retirement allowance every month for the rest of your life. Option 2 is the same as for the other tiers. If you're age 70, you can retire with any amount of service credit, even if it's less than the 5 years. Does reciprocity count toward membership time? Yes, it does. So reciprocity does count toward this 10 years of membership, and it does count toward the amount of service credit that you need to retire. It counts for both of those things. And we'll talk about reciprocity a little bit later. Next topic, understanding additional benefits. There are a few other benefits that ACERA offers in addition to the retirement allowance, and that includes medical, dental, vision subsidies and other non-guaranteed benefits. Also disability retirement, so if you become permanently disabled and you can't perform one or more of your job duties, you can apply for disability retirement. And if you want to know more about that, there's a whole disability page on our website, and also death benefits. So let me talk about the non-guaranteed benefits, including healthcare benefits first. These are extra benefits that the employers, including the county, decided long ago our retirees needed these benefits in order to pay for their lives in retirement. So they started a reserve fund to pay for these benefits. These benefits are not guaranteed because they're based on the balance of the reserve fund. And our Board of Retirement administers the fund to ensure its sustainability. So they're monitoring how much comes in every year, how much goes out and is projected to go out. And so they set what the benefits are and the levels of benefits based on how sustainable that fund is. Currently, it's very sustainable. There's almost $1 billion in there. So the board's goal is to continue to have that fund there in order to pay for these types of benefits. There are currently, the benefits are a medical subsidy to help pay for the cost of being enrolled in medical, a dental subsidy, vision subsidy, a Medicare subsidy to help pay for the cost of being enrolled in Medicare, and a supplemental cost of living adjustment that is in addition to the vested cost of living adjustment. Now, we are not going to dig deep into these because these could change by the time you go to retire. These might be adjusted a little bit. The one thing that and what the details are, details of the plans might change. The one thing I do want to highlight here is that the board standard for who qualifies to receive these benefits is mostly based on years of ACERA service credit. And so you can see that the supplemental cost of living adjustment is the only one that doesn't require a service credit, any amount of service credit to qualify for. All of the healthcare benefits start at you having achieved at least 10 years of ACERA service credit by the time you retire. And that does not include reciprocal service credit. And then for the medical subsidy, and MMA stands for monthly medical allowance, there are a couple more levels, higher levels of subsidy that you can get if you achieve 15 or 20 years of service credit. So the reason I'm telling you this in the new employee mid-career seminar is just to show you, just to kind of highlight this in terms of career planning. Like, for example, if you were going to work here for 9 years, let's say you've already been here 9.5 years, and you're thinking about quitting before you reach the 10-year mark, maybe you don't want to do that. Because if you achieve 10 years of ACERA service credit, you will have access to these healthcare subsidies in retirement. And between the Medicare, dental, vision, and the first level of the medical subsidy, it's going to be a lot of additional money in retirement that you would get just by getting over that 10-year mark. And the same thing with the 15-year mark and the 20-year mark. So that's the main thing that I want you to know about these right now in terms of retirement planning. And so if we go back to the pension milestone chart, I'm just going to move this one aside here and put the healthcare subsidies number here to illustrate the fact that this is another milestone that you may want to be thinking about. If you want more details about our healthcare plans, we have a whole page on our website under the retirees section. And additionally, we take a deep dive into the healthcare plans in the pre-retirement seminar. And yes, you can cover, you can enroll your family members. It's just that the subsidies are only going to be for you, the retiree. Okay. Now let's talk about designating your beneficiaries. I got some questions about this and keeping them current. So who is your beneficiary? Beneficiary is just somebody who gets benefits. Now your ACERA beneficiary is the person that you designate to get your death benefits from ACERA after you die. And so what are the death benefits going to be? If you are not yet vested in ACERA and you die before you retire, the death benefit is a return of your employee contributions plus the interest that we've paid to your contribution account. So we're going to return all that to your beneficiary. Plus, your beneficiary is going to get 1 month of salary, of your salary, for each year of service that you've already achieved. And that's maxes out at 6 months worth of salary. That is if you're not vested. If you're vested, your beneficiaries will get to choose among these three options. Option 1 is the same thing as I just told you. A return of the contributions and interest plus the 1 month of salary for each year of service, up to 6 months worth of salary. And this is if you die as an actively working employee. And I don't mean that you die at work. I mean that you are still just an active member, okay? Whether you're non-vested or you're vested. Your beneficiaries, if you're vested, will also get these other two options. They could get a monthly survivor allowance for the rest of their life. And it says qualified beneficiary only. And for that, it's spouse or domestic or state registered domestic partner. And I don't know if that includes minor children, but you can look that up on our website. Minor children don't get that for the rest of their life, though. And then for option 3, it's kind of a hybrid of options 1 and 2. They would get 1 month of salary for each year of service up to the 6 months, and then a reduced survivor's allowance benefit. So they would choose between these 3 options. For deferred members are members that were an active ACERA member, you earned credit toward retirement, and then you stopped working but didn't retire yet. So you deferred your retirement to a later date. So we have active members, deferred members, and retired members. So if you're a deferred member and you die, it would just be what your beneficiary would get is a return of the employee contributions and interest, and they wouldn't get any of the salary component because you don't have a salary anymore. Okay, now there's some questions around how to designate your beneficiaries, and who can be a beneficiary. Who can be a beneficiary is answered on this page. This is our death benefits page, acera.org/death. You can designate a nonprofit as a beneficiary. Not for a nonprofit can never get a survivor's allowance, but it can get these lump sums and charities and things like that. The way that you would do that is you would designate it on your beneficiary designation form. Active members can redesignate your beneficiaries at any time. So can deferred members. So you do that on the beneficiary designation form. In order to check who your beneficiaries are, because most of you have probably already designated a beneficiary or beneficiaries, you had the opportunity to do that when you started at Acera on your member enrollment questionnaire. But if you don't remember who you designated, or if you have a hunch that that is out of date, you can check by going into your account on our website, clicking on the nominated beneficiaries page, and seeing if your beneficiaries are current. If you go in here and you see your spouse from 3 spouses ago, you're going to want to go ahead and redesignate your beneficiary. And you do that by clicking this link, and it will take you out to our forms page, and you can redesignate it. There you can't change it on here, and there's no web form for that yet. We're working on that. So it's going to take you out to our website, and then there's a PDF form that you can fill out. And the question, how much is the survivor's allowance? It goes into more detail about that on the death benefits page, which is acera.org/death. Going back to these benefits, this is Acera service credit only. So reciprocal service credit is not included. And the question is, how do you select which option you would like? You don't select which one of these options your beneficiaries get, they choose. So you just designate your beneficiary by filling out the form, and then if you are a vested member, then your beneficiary will make the choice between options 1, 2, or 3. If you are a non-vested member, then there's going to be no choice. It's just going to be this one option. Okay. Did that one. Okay, regarding questions around vacation and how that affects your salary calculation, I suggest going out to our website and searching for vacation, and there's a whole page on how vacation affects your salary calculation. If you want to hang around after the presentation, I can talk more about that. Answered that one. Okay, there's a question, if you sell your vacation, is there any benefit or do you lose a service year? You wouldn't lose a year. If you sell your vacation, you're basically selling your earned vacation back to your employer for cash at the time. And you're like, if you sell a week's worth of vacation, your vacation just goes down, your vacation accruals just go down by 1 week, and you get extra cash in your paycheck. And if you like at the end of your career, you want to work an extra week to make up for that, you could do that, but you don't really lose service time. And then what happens with your pension after you die? So what we were talking about in this whole section is the death benefits before retirement. The death benefits after retirement are a whole additional discussion that we talk about, and we take a deep dive into that in the pre-retirement seminar. There are various options, and those can include a lifetime payment for your beneficiary. If you want to learn more about that, there's a link to that on the death benefits page, acera.org/death, or you can watch a pre-recorded version of the pre-retirement seminar or enroll in the pre-retirement seminar, and we do talk about that topic. Okay, moving on. I had a lot of questions earlier about what happens when you leave work here. What happens if you leave before you're vested? What happens if you just leave? What happens to your contributions? So let's delve into that topic here. I will help you understand your career planning options. Your first option regarding career planning is to work straight into retirement. So you're currently an active member. You're currently working. As you work, you earn service credit toward retirement. As you work, your salary goes up periodically. You get older. So you're earning more and more credit toward retirement. And then at some point in the future, once you're eligible, you decide to retire and you collect that lifetime monthly retirement allowance. We will convert your sick leave if you work straight into retirement on a 2-to-1 basis to service credit up to a limit. So you will get some service credit for your earned sick leave. And you're going to earn service credit right up to the time you retire. And then once you retire from ACERA, you can go work somewhere else if you want. If you want to come back to work for your employer, that's a different topic, and you should explore that topic on our website. But you can go work wherever else you want, and we are going to consider you retired, and you're going to collect your retirement allowance every month for the rest of your life. Even if you were to retire at age 50 or 52 and you go work somewhere else, if you retire from ACERA, you're just going to get that monthly check every month for the rest of your life, because you can get your ACERA retirement at the same time. Okay, now what happens if you're not going to work straight into retirement? This is kind of what all the questions earlier in the presentation were geared toward. If you terminate your employment before you retire for whatever reason, you're going to have 3 options. Okay, and I'm going to label those A, B, and C. And we're going to stick an additional milestone on the milestone chart here, which means that you're terminating your employment before you retire, so there's a gap here. So in your case, you will have earned retirement between your date of entry into ACERA and the day that you stop working. And then there's going to be a gap here where you're still an ACERA member, maybe, but you're waiting to retire, maybe, depending on which option you select. So let me show you what those are. You have 3 options, options A, B, and C. Option A is that if you stop working and you don't want to retire yet, or you can't retire yet because you're not eligible, you can defer your membership, and which I mentioned earlier means that you're deferring your retirement to a later date. When you defer your membership, you're leaving your contributions on deposit with ACERA. So we're going to maintain your contribution account at ACERA, and we're going to continue to invest your money. As a deferred member, you're still an ACERA member. Interest in your account accumulates, and in fact, we do not pay negative interest. And by that I mean, if ACERA's fund experiences adverse investment experience, that does not affect your contribution account, or your contribution account does not decline. Your contribution account only grows. So if we lose money, you don't lose money. Okay? There are almost no places, probably no places, that you can park your money that earn the type of interest that we typically earn, that there's no risk in terms of losing some of your money, losing your account balance. So it's a pretty safe place to keep your money if you are going to defer. As a deferred member, you can retire later. Like maybe you stopped working and maybe you deferred your retirement to a later date because you weren't eligible yet. But then later you achieve that retirement eligibility, one of those scenarios. Then you can retire out of deferred membership and start collecting that lifetime monthly retirement allowance. As a deferred member, you don't have to retire later. If you left working here because it wasn't kind of your thing, but then you go try something else and that's not your thing either, and you want to come back and get another job with one of ACERA's participating employers, the county or one of our other 5 participating employers, you can do that. And what happens is you come back to work and you start earning more retirement where you left off. And as a deferred member, you could be refunded at any time. So if you don't want to take a refund at the time that you retire, you can be refunded at some point in the future. Okay, that's your first option. That's option A. Option B is establishing reciprocity. Reciprocity is when you link various retirement systems together. So these could be different cities in California, California state jobs, other agencies that use California's retirement system, public retirement system called CalPERS. You can read the full list on our website at acera.org/reciprocity. And what happens when you establish reciprocity is the service credit that you earn under all of the systems that are linked together gets you over that vesting requirement and retirement eligibility requirements. So we look at the whole of your service credit combined among all of the systems. I mentioned that earlier. Also, the highest average salary that you earn under the reciprocal system is going to be used by all of the systems. So if you're making 20 bucks an hour here and you get a new job somewhere else making 30 bucks an hour and you link the systems together, when you go to retire, we're both going to do a retirement calculation, and when it comes time to fill in the salary component of the calculation, we're going to find out what your highest salary is under any of the systems that you have linked together. And you could link a bunch of them together if you want. Also, if you are somebody who did not start out in Tier 4 among any of the systems, then it may keep your contribution rate lower. If you're in Tier 4, then that probably won't be the case. Your contribution, you just kind of pay contributions on a flat rate. So those are the benefits of establishing reciprocity. Now, in order to qualify for reciprocity, you have to leave your contributions on deposit with Acera and every employer that you're linking together. That means that you're kind of selecting option A and B. You're becoming a deferred member, like if you got a job over in Contra Costa County, for example, you would become a deferred member at Acera, and then you would become an active member over at Contra Costa County. There can be no more than a 180-day gap between when you leave your first job and enter the next retirement system. And for the next retirement system, it's not date of hire, it's date of entry into the system. 180 days is about 6 months. So you have 6 months to get that new job or to start the new job. You can't have overlapping service. So you don't want to go on a 4-week vacation when you're finishing your job here and you're in active payroll status for that 4 weeks, and then start a new job immediately for a different agency, because that's overlapping service and then you can't establish reciprocity. So you just make a clean cut here and then you get the new job elsewhere. And they're going to cash you out for your vacation anyway, so you don't have to worry about that. Also, you got to retire from all of the systems on the same day. So we don't have reciprocity with the city of Oakland, I don't think, unless they are using CalPERS, and then we might. You might want to check our reciprocity page to see if we have the city of Oakland. But if we do have reciprocity with the city of Oakland, if it's on, actually we might. If it's on our reciprocity page, acera.org/reciprocity, there's a list. If it is on there, you simply have to have had no more than a 180-day gap between when you left there and when you entered here. If it's more than 180 days, then you can't establish reciprocity. But yeah, if you do have 5 years of service credit for them, and there was no more than 180 days that transpired between when you left that system and when you entered this system, and you left your contributions on deposit there, and you don't have overlapping service, you can absolutely establish reciprocity. I don't think we have reciprocity with the UC system, but that would be something to check out on our reciprocity page. Okay, now, since you wrote back and said it is more than 180 days, what then you could do is I don't know how much the vesting requirement is for the city of Oakland. What you could do is just retire from the city of Oakland and draw their pension, and then you're just kind of earning your pension separately at Alameda County. Or you could take a withdrawal of your funds from their pension and try to buy that time as 5 years of Acera service credit. It's going to be expensive. Okay, moving on. So that's option A and option B. Option C, which I got some questions about, is if you terminate your employment, you can take a refund of your employee contributions and interest. So that is refundable to you. There are some things that I want you to know about that. The first is that if you take a lump sum payment, you will probably lose a third of your money to taxes and penalties. So that'll just disappear. Unless you roll over that money into a different type of pre-tax retirement account, and then you won't have to pay the taxes and penalties. If you want a refund, it can take some time. 45, 60, perhaps more days than that. So it's not an instantaneous thing as soon as you stop working. And when you do that, you waive your right to all the SARA benefits. So what you're doing is you're saying, I'm canceling my SARA membership. Please refund my contributions and interest, and I'm going to go do something else with it. Now, if you recall, there's a couple of reasons not to do that. One is that if you leave your contributions on deposit here, interest is still going to accumulate and we don't pay negative interest. So it's a safe place to invest your money. Another thing is that you can retire later out of deferred membership if you achieve retirement eligibility. So let's say that you are a Tier 4 member, you achieve 5 years of service credit, and you're not age 50 yet. Maybe you're age 40. Well, and you're done working here. Well, it's 52 for general members. So what you can do is you can stop working here and you can wait and decide later if you want. You could be refunded later, or you could wait until age 52, and then you're going to actually receive your retirement allowance at age 52 every month for the rest of your life. And I already told you that in retirement, you're going to get all your money back within the first 3 to 5 years of retirement. So between ages 52 and up to 57, we're already going to give you all your money back. And then from 57 to, let's say you live to 90, you're going to get a payment every month for the rest of your life. So it's a really good deal. And the reason that we have that good deal is because pensions are special, and the employer contribution pays for a lot of that lifetime retirement allowance, or some of it. But it's the interest that we earn by professionally investing our $9 billion fund that gives us the power to pay those lifetime benefits like we do. And the interest is actually going to pay for 75% of that lifetime benefit. So the majority of that retirement that you're getting between ages 57 and 90 in that scenario that I was giving you is paid for by that interest that we've earned. So it's a really good deal to continue to pay to continue to if you can continue your SARA membership and actually retire from a SARA. So that's how that works if you take a refund. I did get some questions about what we invest in, how it compares to other plans. I mean, a pension doesn't really compare to a deferred compensation plan, like a 401k, 457b, IRA, because those are finite amounts of money that can run out. If you retire from a SARA, you're going to get a lifetime retirement allowance every month for the rest of your life. It's guaranteed income. It can't run out. You're going to get it every month for the rest of your life. So that's kind of the difference there. And if you want more, we invest. I got a question about like what we invest in is kind of like a diverse set of investments, and you can check out our investments page, and it has all of our different asset allocations. A SARA is not going to go out of business, to that question. Alameda County is not going to go out of business, and your pension is guaranteed by state law. So it's not going to happen. Okay, so we're running a little bit behind, so I might go through this section a little fast so that we can get to our 457B presentation. Let me just check to see if our 457B representative is here. Here we go. Okay, and then, Gene, I'll just go through this. I'll try to make it, brief so that you can get started, or make it efficient. Okay, let's talk about making a retirement planning picture. We've already seen this slide. Financial planners will tell you that you're going to need 70 to 80% of your income that you were making before retirement in order to maintain your standard of living in retirement. When Gene comes on, he's going to tell you that he wants to get you up to 100% income replacement. And the ways that you are going to have income in retirement are through these three methods: your SARA monthly pension, Social Security, if you've paid into Social Security for enough time to in order to collect it, which I believe is like 10 full-time years. And then everything else is your savings and investments. So let me help you get pointed in this direction to this 70 to 80% income replacement. Step one is get some estimates. Get out a piece of paper, a piece of scratch paper. You don't have to do this right now, but on your own, you get out a piece of scratch paper and you go get these estimates. You go get a SARA estimate and a Social Security estimate. So you go use our pension benefit estimator on our site, and then you go get a Social Security estimate. So here's where you get, again, your pension estimate from a SARA and the benefit estimator. You end up with this. And then so you take this amount here from your pension estimate and your retirement scenario, and you write it down. And you also might want to take note of the age at retirement that you're doing in this scenario. Okay, so let's say that you do your SARA estimate and it gives you $2,200 per month as your pension amount, and that's at age 62. Okay, so then you go out to Social Security's website and you do an estimate from them. When you go through it, you're going to end up with something that looks like this. They're going to give you 3 different estimates based on your data at 3 different ages when you could collect Social Security. Age 62 is the early age when you could collect Social Security, and then your amount increases the later you do it. So let's just say that you do it at age 62, or you could write all these down. You choose your own scenario. We'll stick with age 62 for this scenario. So in this scenario, our SARA estimate says basically $2,200, and our Social Security estimate says $1,700 at age 62. What I recommend is trying various retirement calculators with this data to get pointed in that 70 to 80% trajectory. I'm going to show you the Vanguard calculator. I think that Gene, our deferred comp representative, will show you the Prudential calculator inside your Prudential account if you sign up for a 457B account. What these do is these kind of give you different scenarios to get you on that trajectory. Okay, so let me actually just go out to the Vanguard calculator and show you how it works. I'll just do a little demo here. Okay, I'm on the planning your retirement page. So this is, again, is members, and then planning your retirement. Sorry about that. Okay, so scrolling down here, this planning your retirement page is kind of the long version, the detailed version of what I'm doing for you now. It kind of takes you through it step by step, and so you can click on the Vanguard calculator and come out here. Now this is a just a retirement scenario that you're doing. So you're thinking, let me see, let's see what happens if I retire at age 62. Let's say I'm 30 years old right now. And let's say my salary is $70,000, just for a nice round number per year. And let's say that currently I don't save very much toward retirement. I save $100 a year toward retirement. Not very much. How much have I already saved? Maybe, let's say it's like $5,000. If it's zero, it's zero. So don't stress out about this, because what this is going to do is get you pointed in that trajectory of saving a little bit more, so you actually have some additional savings to count on in addition to what the pension that you're going to get from a SARA. And so this number right here is the income replacement number. So I mentioned that it should be 70 to 80%. You could go more than that if you want to see what happens. You go up to 90%, but we're going to stick with 70% income replacement. So this means that whatever you're making before retirement, you want to get your trajectory going so that by the time you retire, you're going to achieve 70% income replacement through your SARA pension, Social Security, and your additional savings. This number here is your expected annual return. Now, this is basically asking you how risky do you think you're going to be with these additional investments that you're going to make. This number should be somewhere between 2 and 7, I think. 7 is kind of what a SARA expects to make in our investments, and we invest kind of conservatively. 2 is super conservative, and you can probably get that through various mutual funds, which are pretty darn safe, so pretty low risk. So let's be a little bit risky, but not very risky. Let's say 6%. Okay, and we're going to hit calculate. Oh, sorry, and I forgot this important part right here. This is where you put in your estimate from Social Security. So if it was $1,700 in that scenario per month, and then the estimate from a SARA, it was like $2,200. And so then we hit recalculate. And what this is doing, what our goal is for these bars to be kind of even. Okay. And so this is really strange that it's saying it's already kind of even at saving $100 per month. Let me go up to 80% income replacement and see what happens, just for the sake of the example. Okay, so we have a gap here. This is what you're going to need if you're going to achieve 80% income replacement. Okay, because you're going to get money from a SARA in your pension. That's going to get you to a certain percentage, and you're going to get that additional money from Social Security that's going to get you another percentage, and then everything after that to fill in the gap is going to be your additional savings. And so what you need to do is increase this number. Let's try $2,000 per year and see what happens. Until, let me skip ahead here and see what happens, until these kind of get even. Okay, so I kind of overshot it. This used to be a lot easier. They changed this recently. There used to be sliders and you could do it all in one thing. Okay, so there we go. So what this is saying is that in this scenario, if I'm 30 now and I'm gonna retire at age 62 and this is my current salary, and I've already saved $5,000, and I'm aiming toward 80% income replacement, and I'm gonna be kind of this risky with my additional savings. I'm going to need to save $4,000 additional dollars per year in order to get that 80% income replacement. If I don't, I'm going to have a gap and I'm not going to get 80% income replacement. It's going to be something less, 70, 60, 50. It's going to be something less. And so I'm not going to be able to maintain my standard of living. So in this scenario, so I would just save that additional $4,000 per year, and that is about $153 per pay period. So that's not that big a deal. So if you just save $153 additional dollars per pay period in this scenario, then you would get pointed at that 80% income replacement. So let me switch back to the PowerPoint presentation here. And the whole idea with this is not to exactly have, by the time you retire, exactly how much you need to retire. There's too many variables in play. All I'm trying to do with this demonstration is get you pointed at this number. So you go do the calculator and you get pointed in a direction. And maybe you come back every 6 months and redo the calculator, or 6 months or a year. And when you come back, you're not pointed at 70 or 80% anymore. So you maybe want to save a little bit more. So you increase your savings into like your additional savings so that you're pointed in that direction. And then you come back and do it in a year, and you just kind of readjust as you go along and readjust your additional savings. And that way, by the time you retire, you will have achieved that income replacement that you need to maintain your standard of living. So the question is where to save your additional money. I had the question earlier, can you contribute more money to a Sarah's fund in order to get more pension. No, you can't. But if you do have more money that you could contribute, what you can do is contribute it. You can put that money in a place where you can earn some interest. And that will help you beat inflation and earn more money through the power of compound interest. And what I want to tell you about that is you're going to be in charge of where you're saving your additional money, because it doesn't really have anything to do with a SARA. A SARA is going to take your contributions, calculate your retirement, and pay you your lifetime retirement allowance when it comes time. Anything beyond that is you choosing to save your money in a certain place. And in general, they say that the riskier the places that you save your money, or the places that have the potential for a higher return, or increase the amount of risk that you're taking. So that's just a general rule. And then there are some different places that you can save your money. We're especially going to highlight the county's 457B account. And I'm going to turn it over to Jean Hilliard in just a minute to take you through that, because there are different types of defined contribution accounts, what they call defined contribution accounts, like 401ks and IRAs. What you have access to as government employees is a 457B account, where you can save money on a pre-tax basis and get a lot of advantages from it. And Jean's going to take you through that. There are some lower risk options that I've outlined here. There's a lot of details about what each one of these mean out on our website on that planning your retirement page, so I won't go into them here. But just do your own research. And you can research if you max out how much you can put in your 457B account, and you want to go out and find out different investments on top of that, that's great. So we have more information about that on our planning your retirement page. Do be cautious currently, because we're in a pandemic, and investments, if you're looking for short-term gains, that's generally looking for short-term gains is always a risky endeavor. So when we're talking about earning, like when I was talking about earning 6% on your investments over time in that scenario that I was giving you in the Vanguard calculator, that's through long-term investing, where you're leaving your money to grow through the power of compound interest over decades. If you're looking for short-term gains, that's kind of up to you. So you can do that at your own risk. And if you need more help, there are free financial planners from the Deferred Compensation Program, including Jean, who's about to give you the deferred compensation presentation. And then there's some other options here. If you do hire a financial planner on your own, look very closely at their fees, because they're often pretty bad. They'll charge you like 1% to manage your money, which is going to really cut into your compound interest over time. And again, that page that we go into more detail about this is acera.org/planning. And then just really quickly, if you want to sign up for Acera News, you can do that at acera.org/subscribe. We hardly send anything out, maybe like once per year. It's only when important stuff happens with Acera. So you're not going to be inundated with stuff when we don't sell your information.